Gold is an unusual asset in that it isn't really a commodity and it isn't really a currency, but it is a form of monetary asset. There is currently $2.4 trillion of gold in circulation at the moment. So for many investors, it's seen as a place to park your cash when they're concerned about other investments. It's difficult sometimes to understand what drives the demand and supply. Typical demand from, say, the Indian wedding season doesn't really apply to movement in gold prices. As gold is a monetary asset, it's a lot to do with interest rate cycles, inflation, political risk, for instance. So take political instability for this year, for instance. We have elections in March with the Netherlands, we have elections in France through April throughout May, and then we have elections in Germany. Also, there's a bedding in period for Donald Trump in the United States. So a lot of these issues are creating political instability. There's another risk out there this time. We've had 9 years of very loose monetary policy. So very low interest rates from the Bank of England, the ECB, and the Fed in the United States. Many investors now are asking the question, what happens when we take this stimulus away? And no one quite knows. The stimulus has led many people to pile into traditional safe haven assets like government bonds, for instance, but that has pushed them into sort of bubble territory. And many investors are very worried when interest rates start to rise, as we expect them to, that bubble may pop. One way of mitigating that risk, again, is gold. And then finally, the other sort of core risk is inflation. There's a big worry that central bankers don't react to rising inflation. We're starting to see rising inflationary pressures, particularly because of rising commodity prices, for instance, rising food prices, rising oil prices. And typically, a central bank like the Bank of England would react by increasing interest rates to mitigate the problem of rising inflation. But increasingly, we're seeing a trend of central bankers remaining what we'd say very dovish, in other words, not reacting so much to inflation. Gold in that kind of circumstances tends to do quite well. We remain pragmatic about the gold price, though. We don't believe we see a significant upside to the gold price. Our fair value for mid-year is $1,300, and we expect by the end of the year it will end up around $1,230. So in the shorter term there is some potential upside, but crucially, gold is not necessarily always about capital appreciation. It's about being an event risk hedge. Thank you for listening.